I want you to imagine a very specific, almost universal experience for a second.
Okay, lay it on me.
So, you're walking into your local corner store,
Hmm.
and it is the absolute peak of a blisteringly hot summer day.
Oh, man. The kind of heat that just, like, radiates off the pavement.
Exactly. So, you make a beeline straight for the back of the shop, right? You bypass all the shelves of dry goods, and you head right to that glowing, humming glass door fridge.
You're on a mission at that point.
Right. You reach in, you feel that sudden glorious blast of cold air, and you grab an ice cold Pepsi.
Or, maybe a Mountain Dew.
Yeah, or a Sting energy drink, whatever your go-to is. You pay at the counter, you crack it open, and as you take that first sip, you probably think to yourself that you are buying a product manufactured, bottled, and distributed by the global titan, PepsiCo.
I mean, that's what the label says.
Right. But here is the secret hiding in plain sight. You aren't.
Not even a little bit.
No. In reality, you are interacting with a completely different, almost entirely hidden titan of industry, a company called Varun Beverages Limited, or VBL.
It truly is one of the most phenomenal illusions of the modern consumer market.
It really is.
Because you, as the consumer, you see the globally recognized brand colors, right? You see the logo, the marketing campaigns on television, but the physical reality of that product is entirely decoupled from the brand owner.
Decoupled in a massive way.
Yeah, the actual liquid inside the bottle, the plastic of the bottle itself, the logistics network that put it on the truck driver who navigated rural roads to deliver it.
And perhaps most importantly, the refrigerator you just pulled it out of.
Exactly. All of that is orchestrated and owned by a completely separate entity, VBL.
And the sheer scale of this invisible empire is exactly what we're unpacking today. The mission for this deep dive is to dissect the anatomy of India's largest PepsiCo franchisee.
And when we say largest, we really need to put some numbers to that scale, just to ground this conversation.
We do, because we're looking at a company with a market capitalization of roughly 1,35,700 crore rupees.
Which is just, it's a staggering number.
It's insane. Let that sink in for a second. A valuation of over 1,35,000 crore for a business that basically, well, pumps syrup into water and drives it around.
Right, that's the cynical way to look at it. But it gets crazier.
It does. Over the last 5 years, they have grown their profits by an average of 50.2% annually.
Every single year.
Every single year for half a decade, their bottom line has expanded by 50%. So our goal today is to pull apart this machine. We're going to explore how a supposedly unglamorous, heavy infrastructure business, manufacturing and trucking, manages to pull off the kind of astronomical growth numbers you typically only see in, like, Silicon Valley software startups.
Yeah, the tech multiples.
Right. And we want to see what makes their physical operation virtually impossible for any competitor to replicate.
And honestly, for anyone trying to understand the mechanics of wealth creation, this is a masterclass.
Absolutely.
Whether you're an investor hunting for compounding growth machines or, say, a business student studying the nuances of supply chain logistics.
Or just someone insanely curious about how the physical world actually gets built, stocked, and maintained.
Exactly. Varun Beverages is the ultimate case study here. They are not merely a passenger riding on Pepsi's marketing coattails. They are a foundational, hyper-optimized consumer staple company. They're capitalizing on massive structural tailwinds in emerging markets, and they are doing it with a level of operational intensity that just, well, it defies traditional corporate logic.
So to really grasp how VBL prints billions of rupees, I feel like we have to start at the absolute foundation, like what they actually produce and how this highly unusual relationship with PepsiCo is structured.
Because it really does defy the conventional wisdom of how we assume big corporations operate.
Right. Let's examine the physical output first, the product portfolio.
Okay, so the portfolio is divided into three distinct pillars. The foundation, naturally, is the carbonated soft drinks, or what the industry calls CSDs.
The classic stuff.
Exactly. This is the heavy-hitting, iconic stuff. Pepsi, Mountain Dew, 7UP, and their energy drink Sting. Yeah. And as of 2022, this category alone makes up a massive 70% of their total volume.
I mean, that makes intuitive sense. That is the sugar, the caffeine, and the fizz that built the empire in the first place.
Yeah, that's the core engine. Then the second pillar consists of non-carbonated beverages, or NCBs.
Okay, like what?
This includes Tropicana juices and Gatorade. So it's catering to a slightly different, perhaps more health-conscious or athletic consumer base.
Got it.
But this one only makes up about 7% of their volume.
Oh, that's pretty small compared to the sodas.
It is. But then the third pillar is packaged drinking water, specifically the Aquafina brand. And that accounts for a highly significant 23% of their total volume.
Wow, almost a quarter of what they move is just bottled water.
Yep. And they aren't mixing this stuff up in a bathtub either. The sources detail that VBL operates 48 massive production facilities.
48 factories.
Yeah. And their geographical dominance is staggering. They hold exclusive franchise rights across 27 Indian states, 7 union territories, and several select international markets.
So when you add all of that up, what's their total share of the Pepsi pie in the region?
VBL is handling approximately 90% of PepsiCo India's entire beverage sales volume.
90%. Okay, the mechanics of this franchise revenue model are what make this dynamic so fascinating to me.
It's a highly symbiotic relationship, but the division of labor is really stark.
Yeah, break that down for us.
So PepsiCo, the parent company headquartered in the United States, acts almost purely as an intellectual property holding company in this context.
Okay, so they own the ideas, not the factories.
Exactly. They own the brand equity, the trademark, and the highly guarded secret formulas. So Pepsi supplies the base concentrate to VBL. And in return, they take a franchise fee, which is estimated to be around 10 to 15% of total sales.
I have to pause and push back on this arrangement because on paper, that sounds completely lopsided.
How's...
Well, Pepsi essentially sits back in an air-conditioned office in New York, emails over the secret recipe, ships a barrel of syrup, and collects a 15% tax on every single bottle sold.
Okay.
Meanwhile, VBL is acting as the hardware and the plumbing of the beverage world, while Pepsi is just licensing the software.
That's a good analogy.
Right, because VBL has to acquire the real estate. They have to spend billions to build those 48 factories. They're the ones hiring tens of thousands of factory line workers, purchasing massive fleets of heavy-duty trucks, and handling the brutal, hyper-local logistics of navigating Indian traffic to deliver glass bottles to millions of tiny storefronts.
All true.
So if VBL is taking on all the actual capital risk and doing literally all the physical labor, why would they ever agree to give Pepsi such a massive cut?
Great question.
And what is stopping Pepsi from just waking up one morning, deciding India is a gold mine, revoking the franchise agreement, and taking all the profits for themselves?
Well, that right there is the multi-billion-dollar question. And honestly, it's the key to understanding VBL's valuation.
Walk me through it.
The arrangement appears lopsided until you factor in the ultimate prize in the fast-moving consumer goods industry. And that is geographic exclusivity.
Okay, exclusivity.
Right. By holding these exclusive rights and successfully renewing them since the 1990s, VBL has constructed an impenetrable, contractually enforced wall around its designated territories.
So nobody else can even try to sell Pepsi there.
Exactly. And to answer your second point, Pepsi doesn't revoke the contract because Pepsi actively avoids capital-heavy operations in emerging markets.
Ah, so they don't want to do the dirty work.
They absolutely do not want the headache of buying land, navigating local zoning laws, dealing with regional labor unions, and maintaining fleets of trucks across 27 Indian states.
Yeah, that sounds like an administrative nightmare from half a world away.
It is. Pepsi wants asset-light scale. So VBL gladly takes on that immense capital burden because, in exchange, they receive a protected monopoly over world-class, universally demanded brands within their territory. No one else is legally permitted to manufacture or distribute a Pepsi in a VBL zone.
Oh, I see. So it's basically a mutually assured success pact. Pepsi gets to be a high-margin intellectual property business, and VBL gets a government-enforced, contract-backed monopoly.
Precisely. Furthermore, because VBL captures both the manufacturing margin, meaning they make a profit on actually bottling the liquid,
Right.
and the distribution margin, meaning they make a profit on delivering it to the store, they control the entire economic engine. From the moment the syrup arrives at their factory doors to the moment you, the consumer, open the fridge.
Wow. So that vertical integration must allow them to squeeze efficiencies out of the supply chain that a fragmented system simply couldn't achieve.
Absolutely. And to quantify what that exclusivity is worth, consider this. VBL generated 20,765 crore rupees in revenue in 2024 alone.
Over 20,000 crore.
Yeah, and that represented a 24.7% jump year over year.
That is just mind-bending. Generating over 20,000 crore rupees just acting as the exclusive plumber for Pepsi's software.
It's a very lucrative plumbing gig.
Clearly. But let's dig deeper into the physical mechanics because, frankly, mixing syrup, carbonated water and sugar is not exactly rocket science.
No, it's a very simple process.
Right. The barriers to entry for making a fizzy, sweet liquid are incredibly low. Anyone with a mid-sized factory and some food-grade equipment can formulate a soda. So the actual magic, the impenetrable moat that prevents local upstarts from dethroning them, it has to be the logistics.
You've hit the nail on the head. Distribution is VBL's true, unassailable moat. But placing it within an arm's reach of 1 billion consumers, that is monumentally difficult.
Okay, so let's look at their reach. How big is this network?
Currently, VBL physically reaches about 4 million FMCG outlets.
Okay, let's quickly define FMCG for anyone listening. That's fast-moving consumer goods. So these are the low-cost, high-volume products we buy daily and consume quickly. Soda, soap, potato chips, toothpaste, that sort of thing.
Yeah.
So to say VBL reaches 4 million of these individual stores, I mean, think about the staggering logistical nightmare of that. We aren't talking about dropping off pallets at 5 massive Walmart distribution centers.
No, not at all.
We are talking about coordinating routing software, driver schedules, fuel costs, and physical inventory for 4 million distinct, often tiny drop-off points. And many of those are in hard-to-reach rural areas.
And they are doing this in a country with an estimated 12 million total FMCG outlets.
Okay, so they're hitting a third of the market.
Right, and VBL is aggressively compounding their reach. They're adding 10 to 12% new outlets to their roster every single year.
That's a huge growth rate for physical infrastructure.
It is, but the genius of their distribution strategy isn't just about dropping off cardboard boxes of soda at a shop and hoping the store owner sells them.
What is it then?
It's about the deployment of permanent physical infrastructure inside the store itself. And this brings us to a data point from the sources that, frankly, borders on the surreal.
Okay, I'm ready.
VBL has an explicitly cited deployment of 10.2 crore Visi-coolers.
Wait, I need to stop the conversation right there to make sure we process that number correctly. 10.2 core. That equates to 102 million Visi-coolers.
That is correct. 102 million.
I really want you, the listener, to visualize the sheer physical mass of what we are discussing. 102 million glass door refrigerators.
It's almost impossible to picture.
Picture them sitting in tiny Tirana stores, roadside dabas, modern supermarkets, and local restaurants across the country. The industrial effort required to manufacture 102 million refrigerators.
To transport them on trucks.
To physically carry them into stores, plug them in, and then maintain the Freon levels and compressors of 102 million machines. The scale is almost Lovecraftian. It is an empire of cold air.
That's a great way to put it. It is an unparalleled ecosystem control mechanism, because competitors cannot easily replicate this. Building a dense, rural-reaching network equipped with 2,500 primary distributors, over 30 massive owned depots, and 102 million active coolers that requires decades of continuous, grueling, and heavily capitalized investment.
You can't just throw venture capital at that problem.
Exactly. You cannot raise VC funding today and build a 100 million cooler network tomorrow. It is a slow, methodical conquering of physical space.
You know, this is where my perspective on VBL completely shifts.
Yeah.
Yeah, because I used to look at them as a delivery and logistics company, but they aren't. They are a real estate company. They're landlords.
Oh, that's interesting. Explain that.
Think about a tiny, crowded corner store in the middle of a brutal June heat wave. What is the single most valuable piece of real estate inside that entire shop?
Well, it's definitely not the cash register.
No, it's the cold shelf, the chilled glass door. VBL doesn't just rent that premium shelf space from the store owner. VBL literally owns the building the shelf sits in. They provide that expensive refrigerator to the store owner entirely for free.
And the psychology and the economics of that free refrigerator are brilliant. Because by providing the Visi-cooler, VBL effectively dictates exactly what goes inside it.
Right. A store owner isn't going to rock the boat.
Exactly. They are highly unlikely to take a free branded Pepsi refrigerator, which VBL is paying to maintain, and stock it full of a rival's cola. The cooler acts as a permanent physical barrier to entry for competitors.
It is a Trojan horse made of glass, steel, and Freon. The store owner invites it in because it cools their store and attracts customers, but it quietly establishes a permanent monopoly in the corner of the room.
That's exactly how it functions.
But let's look at the math you mentioned earlier. VBL reaches 4 million outlets out of an estimated 12 million total outlets in India.
Which leaves a staggering 8 million storefronts completely unserved.
Exactly. 66% of the addressable market hasn't even been touched yet.
And that gap between the 4 million they have and the 8 million they don't is the runway. It is the primary reason the broader market assigns such a premium valuation to the company.
Because the growth path is so clear.
Yes, the runway for mechanistic, highly predictable growth is vast. VBL does not need to sit in a lab and invent the next iPhone to secure its next decade of revenue.
They just have to keep doing what they're already doing.
Precisely. They simply have to execute a proven playbook. Systematically, year by year, they finance more trucks, manufacture more visi-coolers, and extend their supply lines to the next village, the next town, slowly absorbing those 8 million unserved stores into their ecosystem.
Okay, but expanding physical reach only answers half the question. Adding stores explains how they can consistently grow their top-line revenue,
Right.
the sell more volume.
Yeah.
But volume growth doesn't automatically equal margin expansion. I was looking really closely at their financials in the source material. How does selling slightly more soda translate to a 50.2% 5-year profit CAGR?
It's a phenomenal metric.
And let's quickly define CAGR for listener compound annual growth rate. It's a metric that smooths out volatility to show the average rate of return. So a 50.2% CAGR means their profits aren't just growing, they are snowballing, expanding by half their size every single year for 5 years straight.
It's massive.
It is. Growing sales is impressive, sure, but compounding physical profit by 50% annually in an industry constrained by the laws of physics and logistics. We have to dissect the macroeconomic tailwinds and the exact financial machinery driving this because it doesn't seem possible.
Well, the profit explosion is the result of external cultural shifts meeting internal financial leverage. Let's address the external tailwinds first. VBL is currently surfing massive structural macroeconomic shifts in the developing world.
Okay, like what?
The first is rapid urbanization, coupled with the formalization of distribution. As national infrastructure improves, better highways, more reliable electricity grid to power those 102 million coolers, and retail becomes more organized, VBL's established logistical pipes can pump significantly more volume with less friction.
That makes sense. Easier roads, faster trucks.
Exactly. However, the second tailwind is vastly more impactful to their profit margins, and that is premiumization.
Premiumization. That is the industry term for convincing consumers to trade up from the basic, cheap option to something more expensive, right?
Precisely. Consumer palates and spending habits are evolving rapidly. A decade ago, the focus was purely on pushing high volumes of affordable, basic cola.
Just moving cases of Pepsi.
Right. But today, VBL is aggressively marketing products like their energy drink, Sting, as well as an expanding portfolio of value-added, milk-based beverages.
And those cost more at the register.
Exactly. Energy drinks command a significantly higher retail price point than a standard soda. Yet the actual cost to manufacture the liquid is not proportionally higher. Consequently, the profit margin on a bottle of Sting is incredibly juicy compared to a bottle of standard Pepsi.
Okay, so they are pushing more volume through the network, and the products they are pushing have fatter margins. But I still don't think that fully accounts for a 50% snowballing profit.
It doesn't. There's more to it.
I thought so, because I was reviewing the quarterly breakdowns in the sources, and this is where I had a genuine aha moment, but I want to make sure I'm interpreting it right.
Let's hear it.
Their financial structure seems to be defined by extraordinarily high fixed costs. They have to pay the mortgages on 48 massive factories. They have to pay the salaries of thousands of drivers and line workers. They have the depreciation and maintenance on over 100 million refrigerators.
Correct.
And those costs exist whether they sell 1 bottle or 1 billion. On the flip side, their variable costs, the actual Pepsi concentrate, the raw sugar, the PE plastic resin used to blow the bottles, remain relatively steady per unit.
You have identified the exact pivot point of their entire business model. It's called operating leverage.
Operating leverage.
To understand how VBL prints money, you have to understand the extreme seasonality of the beverage industry. People drink vastly more cold liquids in the summer than in the winter.
Obviously.
So during VBL's low-volume periods, specifically Q3, which encompasses the cooler winter months, their operating margins actually plummet to 15.2%.
See, at first glance, seeing margins drop to 15% makes it look like the business is struggling.
It looks weak until you look at the mechanics. In November, the factory might only be running at 40% capacity, but the bank still demands the full mortgage payment for the facility.
The truck drivers still collect their salaries.
Yes, exactly. The electricity bill to keep the lights on remains constant. In Q3, those massive, immovable fixed costs eat up a disproportionate chunk of the incoming revenue, dragging the margin down to 15.2%.
Right. They are essentially subsidizing an empty factory during the winter.
But then, observe the high volume periods. The peak summer months across Q1 and Q2. During this blistering heat wave, consumer demand skyrockets. Revenues in these peak quarters top 7,000 crore rupees.
Huge jump.
Now, apply the fixed cost logic. During the summer, the factory mortgage, the depot leases, and the baseline salaries have already been entirely paid for by the initial baseline sales. The fixed cost bucket is full, so to speak.
Oh, I see where this is going.
Therefore, every single extra bottle of Pepsi or Sting they manufacture and sell beyond that break-in point costs them almost nothing except the raw plastic and syrup. The gross margin on those incremental summer bottles drops almost entirely to the bottom line as pure, unadulterated profit.
Wow.
This dynamic pushes their implied operating margins up to a staggering 23 to 25% during the peak season.
This is the magic trick. Once the factory is built, the Visi-cooler is humming in the corner store, and the delivery truck is already rolling down the highway. Adding just one more case of Sting to the back of that truck costs VBL virtually zero in extra overhead.
Yep. The driver's hourly wage is a sunk cost.
The diesel fuel is a sunk cost. The revenue from that extra case of energy drinks is essentially pure profit.
And when you factor in their 10-year sales, CAGR of 23.2%, meaning top-line revenue has been compounding at 23% for a decade, you begin to see the monstrous power of this engine.
They are continuously forcing an ever-expanding volume of liquid through a pipeline whose fixed costs are already covered.
It is a phenomenal demonstration of industrial-scale operating leverage, and management knows exactly how to tune this engine.
So,
When demand threatens to outpace capacity, they deploy capital to build new greenfield plants.
and greenfield means building a brand new facility from scratch on undeveloped land, right?
Correct. Naturally, when a greenfield plant first opens, it acts as a temporary drag on the company's overall margins because it has high fixed costs but hasn't reached full production volume yet.
Right, it's just getting started.
But within a few months, as the plant stabilizes and hits high utilization, the operating leverage violently kicks back in and corporate profits surge upward again. It's a highly predictable, beautifully engineered financial mechanism.
But it's entirely dependent on one assumption, that volume continues to grow.
Yes, that is the one critical assumption.
Okay, so the Indian market operation is a masterclass. They have this massive runway of 8 million unserved mom-and-pop stores to conquer. They are riding the wave of premiumization with energy drinks, and their operating leverage is a money-printing press during the summer.
That sums it up.
Knowing all of that, a massive question arises when looking at their recent strategic moves. If the Indian machine is running so flawlessly, why is VBL suddenly pouring billions of rupees into the continent of Africa?
The Africa expansion.
And even more confusingly, why are they suddenly pivoting to selling potato chips? Expanding into new continents and entirely new food categories feels like a classic case of corporate hubris. I mean, are they bored?
It is so easy to misinterpret these moves as a lack of focus. But a closer analysis of the logistics reveals they're actually doing the exact opposite. They are not pivoting away from their core competency. They are ruthlessly exporting a proven, localized blueprint to new geographies.
Okay, let's examine the African expansion strategy then.
VBL already had a presence in markets like Morocco, Zambia, and Zimbabwe. But their recent capital deployments have been exceptionally aggressive. They recently fully operationalized a major plant in the Democratic Republic of Congo, the DRC.
Okay.
What is critical to note is that this DRC plant achieved 100% capacity utilization within mere months of opening its doors.
Hitting 100% utilization in a matter of months is absurd for a massive industrial facility. That suggests the consumer demand wasn't just latent, it was practically desperate, just waiting for reliable local supply to come online.
The demand is voracious. But the crown jewel of their recent African strategy occurred in December 2025. VBL acquired 100% of South Africa's Twiza for approximately 11.2 billion rupees.
11.2 billion rupees is a massive check to write. Who is Twiza and why are they worth that much?
Twiza is a prominent domestic South African beverage brand with established local distribution networks. By acquiring them outright, VBL didn't just buy a few factories, they instantly captured roughly 20% of the entire South African soft drinks market.
Boom, overnight.
Exactly. They bought market share, existing retail relationships, and crucial local logistical intelligence overnight.
Okay, acquiring 20% of a major emerging market in one swoop explains the beverage expansion. I see the logic there. But the snacks.
The potato chips.
Yeah. The sources indicate they have secured exclusive franchising rights from PepsiCo to manufacture and distribute snacks. Brands like Cheetos, Lay's, Doritos, and Simba Munchies in Morocco, Zimbabwe, and Zambia. And they have dedicated snack manufacturing plants coming online in 2025 and 2026.
They do.
I have to push back hard on this. VBL is a world-class operator when it comes to blowing plastic bottles and filling them with carbonated liquid. Making and distributing fragile, nitrogen-filled bags of potato chips in Zimbabwe is an entirely different supply chain. Doesn't this violate every rule of staying within your circle of competence?
Your skepticism is completely warranted if you view the potato chip, in isolation. But VBL views the world through the lens of distribution, not culinary arts.
Explain.
If you connect the snack business to the physical infrastructure we spent the first half of this deep dive analyzing, it makes brilliant, ruthless sense. VBL already owns the delivery trucks in Africa. Those trucks are already fully funded, paying their drivers to navigate to thousands of corner stores to drop off cases of Pepsi. Ask yourself, what is the marginal cost to VBL of throwing a few lightweight cardboard boxes of Lay's potato chips into the empty space at the top of that exact same truck?
Oh, wow. I see it now.
You see the synergy?
Yes. The heaviest items in a truck are the liquids. Soda weighs a ton, so a truck often hits its legal weight limit long before it runs out of physical space in the trailer. Potato chips are basically bags of flavored air. They weigh almost nothing, but they take up volume.
Exactly the right deduction. The logistical synergy is near perfect. The truck is already driving the route. The fuel is already paid for. The driver is already scheduled to walk into that specific store to check the visit cooler.
Right.
The additional cost to transport and deliver the chips is virtually zero. Yet, the chips represent an entirely new, highly profitable revenue stream. VBL is merely monetizing the unused cubic volume inside their existing fleet.
That is just, It's so smart.
They are aggressively leveraging their hard-won cold chain and retail relationships. And their strategy of maximizing internal efficiency doesn't stop with snacks. They are executing fascinating backward integration strategies as well.
Let's define backward integration quickly for you guys listening. That's when a company stops buying a crucial component from a supplier and decides to just build it themselves, right?
Precisely. The sources detail that VBL purchased a 50% stake in Everest Industrial Lanka and formed a joint venture with the explicit goal of manufacturing their own refrigeration equipment directly in India.
Wait, let me connect the dots here. Earlier, we marveled at the fact that they deployed 102 million Visa-coolers. You're telling me that instead of paying a third-party manufacturer a premium to build those 102 million fridges, they are now going to manufacture the refrigerators themselves.
That is the strategy. By vertically integrating the production of the Visa coolers, VBL structurally reduces their capital expenditure over the long term.
Because they're cutting out the middleman?
Right. The refrigerator is the most vital and likely the most expensive piece of their physical moat. Why pay a middleman's profit margin on the most critical weapon in your arsenal?
The audacity of this operational design is staggering. They are becoming an entirely self-contained, closed-loop ecosystem. They manufacture the liquid, they blow the plastic bottle. They are now building the literal refrigerator that the bottle sits in. They own the trucks that deliver it, and since they have extra room in the truck, they are tossing in some Doritos to capture the snack margin, too.
It's a vertically integrated juggernaut.
But executing a vision this aggressive, deploying billions into the DRC, executing 11 billion rupee M&A deals in South Africa, launching joint ventures to become an appliance manufacturer, this requires a management team playing a high-stakes, hyper-aggressive game of corporate monopoly. Who are the actual human beings pulling the levers on these capital allocation decisions?
The primary architects of this compounding machine are the promoter and chairman, Ravi Kant Jaipuria, who brings over 3 decades of gritty, hands-on experience in the beverage sector, and the executive vice chairman, Varun Jaipuria, after whom the company is actually named.
When you look at the raw numbers of how the Jaipurias deploy capital, their obsession with growth becomes overwhelmingly obvious. In 2024 alone, management directed a massive 45,000 million rupees, which is 4,500 crore, purely into capital expenditure.
It's a massive reinvestment.
They managed to build and stabilize 3 brand new greenfield manufacturing plants in a single 12-month period. That is an astonishing speed of execution for heavy industry.
What is truly remarkable, however, is not just the sheer size of that 4,500 crore spending spree, but the manner in which they financed it.
Oh yeah, the debt. Or lack thereof.
Exactly. Despite executing massive international acquisitions and building multiple factories from scratch, VBL operates essentially debt-free. Their debt-to-equity ratio sits at an incredibly conservative 0.17.
A DE ratio of 0.17 is practically a rounding error. To put that in perspective for the listener, operating a heavy industrial expansion with a 0.17 debt ratio is like buying a $10 million mansion and paying for 98% of it with a briefcase full of your own cash, barely taking out a mortgage at all. How are they paying for all of this if they aren't borrowing from the banks?
They are funding this continent-spanning expansion almost entirely through their own internal cash generation, specifically the massive summer profits we discussed earlier.
They're just rolling it right back in.
Exactly. They take the cash generated by the Indian operating leverage and immediately deploy it to build the next factory. They do execute occasional strategic capital raises, such as a massive 7,500 crore rupee QIP they launched in 2025.
Let's unpack QIP really quickly. That stands for Qualified Institutional Placement, correct?
Yes, it does.
Instead of doing a highly publicized traditional stock offering to regular retail investors, management quietly issues a block of new shares directly to major institutions, like massive mutual funds or investment banks, to instantly raise a war chest of capital.
Correct. They raised that 7,500 crore not out of desperation to pay down debt, but simply to build a massive liquidity buffer to hunt for more acquisitions.
This philosophy is what really stands out to me. When you scrutinize the source data, looking at their cash flow statements and management commentary, there is a glaring omission. There is absolutely zero mention of returning capital to shareholders via dividends or stock buybacks, not a single rupee.
That omission is a massive signal to the market. It tells us exactly how the Jaipurias view their enterprise.
How so?
Well, typically, when a massive, mature FMCG company, say, a traditional soap or packaged food conglomerate, generates excess cash, they pay out a hefty quarterly dividend. They do this because management essentially admits they have run out of highly profitable internal projects. They don't know how to grow the business any larger, so they give the cash back to the investors.
Right, here's your cut. We can't beat the market with it.
Exactly. VDL refusing to pay a dividend sends the exact opposite message. Management is explicitly stating their belief that the internal rate of return they can achieve by building a new bottling plant in Madhya Pradesh or acquiring a regional competitor in South Africa vastly exceeds whatever return you, the shareholder, could achieve by taking a dividend check and investing it in a generic index fund.
They are the ultimate compounding machine. They relentlessly consume their own cash exhaust to grow larger and faster, and it explains a massive anomaly in the stock market.
Evaluation.
Yes. It is incredibly rare to see a mature business that sells basic commodities like fizzy water and potato chips trading at an astronomical premium valuation of 44 to 51 times earnings. A PE multiple in the 50s is typically reserved for bleeding-edge artificial intelligence companies or hyper-growth software platforms, not a company managing truck drivers and refrigerators.
True. But the market happily pays that premium because investors are pricing in the reality that VBL is a closed-loop engine, continuously feeding its own exponential growth.
It is the valuation of a high-tech software monopoly applied to a deeply physical industrial logistics business.
And the math completely works, generating staggering wealth, provided the machine keeps running flawlessly without friction. But that necessary perfection brings us to the inevitable reality of any fast-growing, highly optimized empire.
The Achilles heel. We have spent the bulk of this deep dive building VBL up as this unstoppable money-printing juggernaut. We've marveled at their distribution moat and their financial wizardry. But every empire, no matter how well constructed, has vulnerabilities. What breaks this machine? What are the structural and environmental risks lurking in the data that could actually derail their ambitions?
The most immediate, visceral, and perhaps ironic risk for a multi-billion-dollar modern corporation is the weather.
The weather, really?
Because the operating leverage we discussed, the business is intensely reliant on the summer peak. If volume drops during those crucial months, the fixed costs crush the margins. And we actually saw this exact vulnerability play out recently in the data.
What happened?
Unseasonal heavy rains in Q2 of 2025, which should be their most lucrative, scorching summer quarter in India, caused a 2.5% revenue decline.
A 2.5% decline sounds like a minor speed bump for most companies, but given their trajectory, that must have been a shock to the system.
It was a seismic event internally. That 2.5% dip represented their first annual revenue decline after an uninterrupted 8-year streak of relentless growth.
It is wild to me. It is absolutely mind-boggling to step back and realized that a financial empire with a 1,35,000 crore valuation, a company executing complex cross-border M&A in South Africa and building factories in the DRC, is literally at the mercy of the monsoon.
It's a sobering thought.
If atmospheric pressure changes and it rains for 3 straight weeks in June across northern India, millions of people decide not to buy a cold Pepsi. The volume drops below that critical fixed cost break-in threshold, the magic of operating leverage violently reverses into a liability, and the stock could theoretically plummet 20% just because it rained.
It exposes a massive vulnerability, but it also brilliantly recontextualizes their strategy, doesn't it? If you are staring at the financial models, how do you mathematically solve for the unpredictability of the weather?
You diversify the variables.
Exactly. This intense weather vulnerability is precisely the hidden motivation behind the African expansion. By geographically diversifying into the African continent, they are acquiring exposure to entirely different weather patterns, different hemispheric seasons, and different climatic cycles. A monsoon in Delhi does not mean it is raining in Johannesburg.
Oh, and the snacks. It completely explains the pivot to potato chips. Snacks are weather agnostic. People will happily sit on their couch and eat a bag of Lay's, whether there is a blizzard outside or a heat wave.
Exactly. The expansions into Africa and PepsiCo snacks aren't just greedy grabs for more top-line revenue. They are highly calculated structural hedges against the volatility of the Indian monsoon.
That is so strategic.
However, while weather is a cyclical risk they can hedge against, the more terrifying threats to their 21% profit margin targets are the structural, regulatory realities of the 21st century.
Okay, let's get into the regulations.
First, you have the persistent regulatory specter of sugar taxes. If regional or national governments attempt to curb public health crises by heavily taxing sugary, carbonated beverages, VBL is forced to raise retail prices. Higher prices inevitably compress consumer volume, which, again, breaks the operating leverage model.
And beyond the sugar in the liquid, there is the massive environmental liability of what holds the liquid, the plastic. The source data highlights looming packaging waste regulations. Specifically, there are strict mandates pushing for all packaging to contain at least 30% recycled plastic by the 2025-2026 timeframe.
Transitioning an operation that produces billions of bottles annually to handle 30% recycled PE plastic is an engineering nightmare. And more importantly, it is deeply expensive.
The sources explicitly estimate that upgrading their supply chain to meet these recycling mandates could inflate their capital expenditure by 5 to 10% of total revenue. That is a massive hidden tax that would eat directly into the bottom line.
And that's not even mentioning the raw materials.
Right. Furthermore, the core raw material for virgin PE plastic resin is derived from global crude oil. If geopolitical tensions cause crude oil prices to spike, or if global sugar commodity prices surge, VBL's variable costs explode. If they cannot pass those increased input costs onto the consumer fast enough by raising prices, perhaps because local competitors are undercutting them, their margins will be severely compressed.
And we cannot ignore that local competition. Upstarts and revitalized legacy brands like Campa Cola are aggressively re-entering the market, deploying deep discounting strategies to steal market share in underpenetrated rural areas.
It's a race to the bottom on price.
Exactly. If a localized price war breaks out, VBL must defend its turf, which necessitates sacrificing high margins to protect sheer volume.
All of those risks, sugar taxes, plastic mandates, price wars, are standard operational headaches for any FMCG giant. But as I read through the deepest parts of the research, there was one specific data point that made me stop cold.
I think I know which one you mean.
It feels like the ultimate existential elephant in the room for a company whose entire business model relies on bottling liquids. The sources explicitly state that 16% of VBL's total production output relies on facilities situated in highly water-stressed regions of India.
This is, without question, the critical long-term threat. It is the ultimate bottleneck. The entire edifice of VBL, the 102 million coolers, the African expansion, the 50% profit growth, is predicated on one foundational assumption: the ability to extract massive, continuous, cheap, and reliable quantities of fresh water from the earth.
You literally cannot manufacture billions of liters of Aquafina and Pepsi without billions of liters of groundwater.
Precisely. As climate change accelerates and regional aquifers deplete, water shifts from being an abundant, virtually free commodity to a fiercely protected local resource.
And that changes the whole game.
If local governments or municipalities in those stressed regions face agricultural droughts, the political pressure to restrict industrial water usage becomes overwhelming. If governments hike the levies on groundwater extraction, or worse, mandate forced reductions in extraction quotas, VBL would face immediate, unmitigable capacity reductions.
Wow.
They might be forced to completely shutter highly profitable greenfield plants or attempt to relocate them to water-abundant regions at a catastrophic capital expense.
It really puts the fragility of the physical world into perspective. Let's try to synthesize this incredible journey we've been on. We started an hour ago standing at a corner store fridge, looking at a simple bottle of cold soda.
Seems like a lifetime ago.
Right. We peeled back the branding to reveal how VBL utilizes exclusive PepsiCo intellectual property to construct a legally protected monopoly. We analyzed how they weaponize a staggering physical distribution network, deploying an incomprehensible 102 million visicoolers to physically own the most valuable real estate in the country.
What gold?
The cold shelf. We broke down the mechanics of operating leverage, showing how high fixed costs turn summer sales into an avalanche of pure profit. And we explored how management is brilliantly hedging against the weather by exporting this exact logistical blueprint to the African continent and into adjacent weatherproof categories like snacks, all funded entirely by their own compounding cash flow.
And they're executing this high-wire act while simultaneously navigating intense cyclical headwinds like unseasonal monsoons, fending off local price wars, and bracing for looming expensive structural threats like mandatory plastic recycling and regional water scarcity. It is a profoundly delicate yet brutally optimized industrial machine.
It really is a marvel of modern capitalism. I want to remind you, the listener, that the next time you walk into a convenience store, the next time you pull open that heavy, glowing glass door and feel the blast of cold air on your face, I challenge you not to just see a simple, sugary beverage. You are looking at the terminal point of a staggering logistical empire.
That's beautifully said.
You are witnessing a real-world masterclass in operating leverage, supply chain domination, and the absolute uncompromising power of owning the last mile.
But as we close, I want to leave you with one final complex thread to pull on in your own time. We have marveled at the immense scale of this operation, the millions of coolers, the thousands of trucks, the incredible 50% compounding profit growth. But considering that a full 16% of VBL's production relies on factories in water-stressed areas and global climate patterns are becoming undeniably more erratic, triggering not just unseasonal summer rains, but prolonged, devastating droughts, what happens when the fundamental assumption of the beverage industry breaks down?
That's the big question.
What happens when access to cheap, abundant water ceases to be an industrial right and becomes a highly politicized luxury? Will the ultimate existential test for this unstoppable distribution juggernaut be its ability to secure the very resource it puts into the bottle?
A heavy, fascinating thought to chew on the next time you crack open that ice-cold Pepsi.